Short exercise 3-10. We're going to adjust for salaries owed at the end of the year. Walnut Park Senior Center has a weekly payroll of $7,500. December 31st falls on Wednesday, and the company will pay its employees on the following Monday for the previous full week. And then assume Walnut Park Senior Center has a 5-day work week and has an unadjusted balance in salaries expense of $550,000. So the easiest way to do this problem is to create a little calendar and input the data on the calendar. So first of all, it says the company has a weekly payroll of $7,500. That means in total to all their employees, they pay $7,500 a week. And notice it says that they have a 5-day work week. So in Excel, I've created a little calendar, and the 5 days of the 5 work days are in gray. So those are the only days that the people are getting paid for. And so remember, the company has a weekly payroll of $7,500 for a 5-day work week, Monday through Friday. So that means $7,500 divided by 5 days. That turns out to be $1,500 per day. So I plugged in $1,500 per day to show exactly what's going on. And each Monday is payday. So for this work week in the red triangle, that will be paid on the following Monday, on January 5th. But here's the deal. December 31st falls on Wednesday. It's the end of the year. So because it's the end of the year, we have to update all of our accounts. So think to yourself now, how much does the company owe its employees for salaries as of Wednesday, December 31st? Remember, they pay every week. So all they owe on December 31st is they owe for December 29th, December 30th, and December 31st. They don't owe for the previous week because the previous week was paid on this Monday. Remember, this company pays every week on Monday. So on December 31st, we have to show that the company owes $1,500 plus $1,500 plus $1,500 of salaries to their employees, but they're not going to pay it. So we have to show wages payable or salaries payable, whatever the company has chosen to call it. So $1,500 times 3 days is $4,500. And the easiest thing to logic our way through first is the debt that the company now owes to its employees. So the company now owes $4,500 to the employee. So that's a liability. So is this liability decreasing or increasing? Well, it's increasing. So we have to credit some type of liability that shows that we owe our employees money. And so this company calls it salaries payable. They could have called it wages payable. It all depends on what they choose. And then for the other account, for the debit, we have to increase an expense called salaries expense. And how do we increase an expense? We increase it with a debit. So that's why we are debiting salaries expense. And this is called accruing salaries expense. Accruing means you're recording something that has not been paid yet. In this case, the salaries have not been paid yet, but we're recording it now because it's the end of the year. Fantastic. All right, post the adjusting entry to the accounts involved and show their balances after adjustments. So this obviously is the adjusting entry. So we have salaries expense, $4,500 debit on December 31st. $4,500 debit, December 31st. That gives us a balance of $554, $500. $554,500 of salaries expense for the period. And then we need to post salaries payable. So the company now owes $4,500 salaries as of the end of the year, which gives them a balance of $4,500. Now record the journal entry for payment of salaries made on January 5th. So it is now January 5th. It's payday. So how much cash are we going to pay on January 5th? Well, remember, each Monday is payday for the previous 5-day work week. So we're going to pay our employees for $1,500 times 5, which is already calculated over here, $7,500. So our cash is going to go down for $7,500. The reason I'm starting with cash is because that's usually the easiest one for students to figure out. And since cash is going down and cash is an asset, we have to credit cash. So I'm going to skip to the third line, which you'll see why in just a bit. So our cash is going to go down by $7,500. Now let's go back up here to this salaries payable. So on December 31st, we owed our employees $4,500 for the previous 3 days. December 29th, December 30th, December 31st. Now on January 5th, where we're paying for the whole week, do we still owe this $4,500? No. We have to lower or get rid of this $4,500 debt because we are paying it off. And of course, to lower a debt, you're going to decrease it with a debit. So salaries payable is going to decrease by $4,500 because we no longer owe our employees that money. Now, notice we have debits that do not equal our credits. If you want to do kind of the cheating method, you can just figure out, well, what's the balancing amount? $7,500 minus $4,500 is $3,000. So now it balances, but what does that $3,000 represent? Let's go back to our calendar. So back on December 31st, we recorded salaries expense right here, the salaries expense. We recorded it for Monday, Tuesday, and Wednesday. But we never did record it for Thursday and Friday because that was in the next year. So now it is in the next year. So we have to record the salary expense for Thursday and Friday. So that is salaries expense. And then notice also when we combine the two salaries expense, they have to equal $7,500. So we got salaries expense of $4,500 here, plus salary expense of $3,000 here, which gives us the total salary expense for the full week of $7,500. And then the explanation is to record payment of salaries. And that's it.